Investors Chronicle.
Hello and welcome back to the IC Interviews podcast, resuming our regular schedule after something of a break from late summer. I'm Dave Baxter, I'm the funds editor on the IC, and today I'm joined by Paul Ffolkes-Davis, chairman of Rising Sun Management. That's the firm that runs the portfolio for the Nippon Active Value Investment Trust, a fund focused on small and mid-cap shares in Japan with something of an activist bent. So Paul, thanks very much for joining. How are you doing?
I'm fine, thanks very much. I'm in Italy and the weather's a lot better than I think it is in Blighty.
Yes, in Blighty it's especially rainy and kind of really heralding the return to autumn and winter, which is challenging, but there we go. So as I mentioned, the trust kind of focused on the small and mid-cap shares in Japan, has performed very well. But yeah, I suppose we're kind of, again, hitting quite a topical moment for Japan. We've had strengthening of the yen. We've recently had a kind of new prime minister come in and so on. First of all, I wanted to kind of address some of those macro factors because the external factors still are big for Japanese equities. In some of the kind of literature for the fund, you guys have spoken about kind of yen strength and the idea that kind of a stronger currency should help the portfolio. How does that kind of work out? And is that still your kind of rough case in terms of the outlook for the fund and markets and so on?
Well, I guess we're going to find out is the answer to that, because the yen is going to continue to strengthen. As you say, we have a new prime minister overnight, Mr. Ishiba, who I guess you have to call a continuity candidate because, after all, he does come from the same party that has run the country for time immemorial. But I think he shares a lot of the outgoing prime minister's views on corporate governance reform and various economic policies that have been driving the market. So we think that all is still reasonably fair. Japan has had a tremendous run, it's true, but you could say that it's been 25, 30 years in coming, and it's certainly not over yet. We started this fund because we thought back in February 2020 that Japan was by far the cheapest of the developed markets in the world. And here we are in the end of September 2024. And guess what? It's still by far the cheapest developed market in the world. So we think it's got further to run. And if anything, our original premise that it was an opportunity to go after companies that were run by what are known as salarymen, i.e. people who not found the company, were not entrepreneurial in their nature, but were there to try and preserve their jobs for life and hug cash and other assets close to their bosom at night to keep them warm. That those companies were vulnerable and needed reform. The timing proved to be perfect, not, I think, because we're so brilliant. Mr. Abe had already started his corporate governance reform program, but during the 4 years that we've been going, it's accelerated consistently, and you have people like Mr. Ueda running the central bank, and you have Mr. Yamaji running the stock exchanges. These are reformers. I often say, when people say, you guys are activist investors, I say yes, but the greatest activist is Mr. Yamaji, because he is the one who is pushing companies to tell him what they're going to do to improve their share price and their liquidity. And it's provided a tremendous wind at our and all the other activists' backs. So we're not doing anything that other people don't do. We do specialize in the small and mid-cap sector, which has proven to be very fertile ground. And there aren't so many activists there. And we do have a slightly different approach to some of our other competitors. We have a large presence on the ground in Tokyo. We tend to take very large stakes now in individual companies. So we've changed a little bit the way we target companies. And we have stuck pretty much at the small end, although we do sometimes go after mid-sized companies. But the formula is working, and we don't see any real macro reasons why it's going to stop.
We'll get back to the kind of activism a bit later, but I suppose sticking with some of the kind of macro themes, it's interesting to see that I suppose Japan is moving into a cycle of interest rate increases, admittedly from a low base, when you know, in other parts of the world, particularly developed markets, UK, US, and so on, you're actually moving into a rate cutting cycle. What does that mean for kind of Japanese equities, and does it kind of change what you might prioritize when you're thinking about the companies you're invested in and the sort of challenges they have to face up to and so on?
Yeah, well, this goes to your first question about the yen. So we have always believed, and as I say, we're going to find out if we're right, that by holding a portfolio of largely small manufacturing, some pharma companies, and increasingly logistics companies, where the bulk of their revenues is domestic, that a strengthening yen is actually quite good for us. I understand that people who are investing in Toyota and Sony might be worried that a strengthening yen will affect their export business. But there is a general consensus, I think, in Japan that actually the weak yen is harming the economy generally. And in particular, now that they're importing a little bit of inflation, still not much by Western standards, but it does capture the Japanese imagination. Now that they're suffering with that, it's put prices up quite a bit. So I think there's a general view that an improving or strengthening yen, providing it doesn't go wild and get out of control, because it's got a lot of ground to make up, is a good thing for the economy generally. And certainly small cap investors, I think, have much to gain from a strengthening yen. We have a graph in our marketing material which shows how we've done since we began. But if you assume we started at 100 and that we're now trading, as of yesterday, our NAV was 194.5. So we've almost doubled our value in four and a bit years. In yen, we're pushing 150% better. So we've given all that value away, if you like, by not having hedged the currency when we began. So we think the yen's got a long way to go. It isn't necessarily going to go back to where it was 2 years ago, but we think it will continue to strengthen. And on the whole, that should be good news for Nippon Active Value Fund.
And in terms of kind of valuations, I mean, I suppose you mentioned the sort of currency distortions and so on, but as we've discussed, Japan has had a pretty rich run of form the last couple of years. With investors now paying more attention to the region, what does that mean for your kind of investment team? Is it now kind of trickier to find decent valuations? And I suppose what pockets are looking kind of attractive still, and are there areas now where you think, oh, you know, the value is more fully priced in and so on?
Well, I certainly think the value is more fully, but not completely fully priced in with the large caps. That is where the market generally has improved. That is where Mr. Buffett has invested. And those companies are no longer as demonstrably cheap as they were, say, 2 years ago. Less true of small and mid caps. We started with a universe of about 700 names that we thought, you know, fitted our criteria, and we can talk about what those are in a minute. We still think there's 400 to 500 of those names there. We think that they're still cheap. They may not be as cheap as they were, although alarmingly, given everything that's happened with corporate governance reform and pressure from the regulators for companies to improve, some of them are just as cheap as they ever were. So there are still net companies where their assets, their cash, their cross shareholdings, their property are greater than the value of their stock exchange listing. So we don't necessarily target companies because they're cheap in that way. We like companies with strong cash flow. We like companies with a good EV to EBITDA. We like companies that are pretty well cashed up, so there is a safety margin if we're not right or things go wrong. We like companies that aren't followed, particularly by external third-party analysts, so people don't necessarily know about the companies very well. And we like companies where the shareholder register is pretty open, not controlled by a parent or a sister or the sort of thing that you typically get with traditional Japanese family companies, but where we think that we can have the greatest influence on management. All of that is still in play. We have a kind of buy list of companies that we're looking to invest in. The number of those companies, if you like, the ones that are being lined up, has remained pretty constant for the last year or so. Currently, the portfolio's got 28 names in it. 2 of those are soon to disappear because they are companies that are being taken private, both by Bain & Company, actually, and both where we will be able to retain an interest in the company once it's gone private. So we're going to try and have 2 bites of the particular cherry. So that gives us 26 active names. That's fewer than normal. We would normally expect to have somewhere between 30 and 35 names. So I think we're pretty fully invested, but as cash becomes available, we will probably go after some new companies as well. And we've had some good news overnight on one of our stocks, which is a company called Ishihara Chemical. It's declared a TOSNet 3, which is basically a mechanism that Japanese companies use for buybacks, buying in their own stock. They've announced that they're going to buy 6.25% of their outstanding, and that will probably take us out. We'll see, but we think we'll probably sell into that tender, and that will give us about 3% of the portfolio back to put in to other names. We'll make about 105% on that position.
I did want to ask, and this is related, kind of, I suppose when people think about activism, there are many different, there's quite a spectrum there in terms of, how aggressive you are and what you do and what kind of actions you encourage. And I suppose buybacks could be one thing, for example, but what form does the activism tend to take for you? And what, I suppose, kind of recently, what sort of things have you been encouraging from portfolio companies?
Well, interestingly, it's changed a little bit. When we began, it was in COVID, and you had a lot of trouble getting management's attention. I remember lots of Zoom calls with people who looked like they were the other end of a cricket pitch, all bunched together because you didn't have cameras that could focus on the individual, all wearing masks. So if you start from the premise that the Japanese are inscrutable by nature, you then add a COVID mask, they become very difficult to talk to. So, the answer in those days used to be no, and we're not playing and whatever. But as they have realized that what we say we do, which is that we are friendly, we are trying to get them to run their company better. Quite often, these are very high quality companies with a good business, but they have very bad capital allocation or they make bad acquisitions. There's always something that attracts our attention that we think they could do better. So because we've helped 1 or 2 companies, one in particular, a company called Mitsubishi Belting that makes rubber timing belts largely for Toyota, and in another country would have probably been part of Toyota's supply chain, but because it's Japan, remains a kind of favored supplier. We help them so much by encouraging them to increase their dividend, to expand and make their board more diverse, to buy back shares. They did all the things that we asked. As a recompense for that, we withdrew our resolutions to their AGM. This was in 2022. We got a nice article written in the Nikkei in Japan, which a lot of other of our portfolio companies read, where the company said they were grateful to us for actually having helped them increase their share price by 3 times and become more liquid and justify their prime listing, which I think they would otherwise have struggled to do. So that now when we appear on a share register, companies are normally willing to talk to us and to hear what we've got to say. I won't say it's all love and hugs, and there are still companies that resist us manfully. I've spoken in the past about a company called Fuji Media Holdings, which is Japan's equivalent of ITV, effectively the largest independent broadcaster. They won't play, but if they won't listen to us, they will listen over time to the government. They're still trading at about 0.4 of book value. Government wants all companies to trade at 1 or above. and their return on equity is still 5 or 6%. Government wants it to be at least 8%. Something will happen to that company in the end, and we will have helped by making everybody aware of just how cheap it is and how it's really a conglomerate and should be broken up. So we're not always nice, and we picked a fight with them and we've gone public about it. But if people will talk to us and they hear what we have to say, we will normally let them get on with it. What's changed over the period is when we began, we used to propose to lots of our companies that we thought were really too small to survive by themselves or justify a listing on Prime, that they should do a management buyout. We think that those are going to happen less and less because one of the guidelines that FEFTA, or the financial regulator, has put out is that if a company is considering a buyout, it also ought to solicit third-party tenders or other buyers, basically. That is going to draw in increasingly the private equity business. Private equity has been waiting for its chance in Japan for a long time, didn't want to be seen as an aggressor as it is in the US or the UK or Europe, wanted to follow Japanese traditions of being, if you like, acting as a white knight and being invited in. Well, effectively, companies that are now thinking of delisting have to make it known that that's what they're considering. And all the companies on our portfolio are being followed by most, if not all, of our PE friends. There are very strict rules in Japan about insider dealing, so we do not collude with PE, but we do talk to them. They do know what we have. They do tell us which companies they're most interested in. And if you like, the benefits of that is starting to be seen in the going private transactions that are currently happening for Teikoku, for T&K Toka, which is a big ink firm, and one of the other portfolio companies that has recently announced a similar transaction called Trancom. Both those companies are being taken private by Bain. Bain led the way on that. We said that we'd be happy to introduce the companies to PE houses, but PE already introduces itself. And we've been able to negotiate something which we always said from day one we wanted to do, which is maintain an interest in some of our portfolio companies when they go private, because most of these transactions are heavily leveraged. So we can end up with a 10 or a 15% shareholding in a private company, costs us practically nothing, a fraction of what the original investment for a smaller percentage of the public company costs. And sooner or later, these companies will either be relisted or they will be sold, and we will make out like the proverbial bandit.
What is the kind of, I suppose, mix in terms of, if you look at some markets like the UK, there's always talk of de-equitization and the kind of opportunity set of private versus public. How are things on that front in Japan?
Well, I think, again, it's a function of the corporate governance reform program and what the regulators are driving. But there were over 3,000 listed companies in Japan when we began. It's about 2,500 now. The regulator wants to see consolidation. There are lots of companies that probably should not be listed at all, or acting as independent companies. It should be in the supply chain of the one or the two customers that they supply almost exclusively. So there's a lot of pressure on these companies to consider their future. So I think increasingly what we're going to see in portfolios such as ours is either companies being taken private, either by themselves through a traditional MBO or via the good offices of a private equity house, or stepping up to the plate, realizing that they're not performing as well as they should, but they have sufficient equity or sufficient value within the system to do buybacks, to increase dividends, to diversify the board, and thus increase their own share price. So those are the two trends that we see. If you ask me where we'll be in a few years' time, I think that 2,500 companies will probably be below 2,000. When the government began pushing companies to explain why they were trading below once book back in March last year, over 50% of the entire market was trading on that basis. By May, it was 43%. We believe it's around 30% now. So you can see that companies either delist or they improve their trading multiples. That will continue.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
Are there other, I suppose, elements of this kind of wide corporate reform program that you imagine still have to have an effect? Because obviously it's been quite a long runway anyway for these changes.
You never know what Yamaji San and his colleagues are going to come up with next. As I say, we had thought most of our companies would end up doing MBOs. We now think that it's going to be private equity. So there's a lot of private equity players in Japan. Not a lot of them have had a lot of success. Sorry for all those lots. Not a lot of them, are necessarily getting a number of deals that they would like. Clearly, the number one house is Bain & Co. That will be annoying Blackstone. It will be annoying Carlyle. It will be annoying Japan Investment Partners. There are domestic players too. They will all be looking to take companies private. So I think we will see, more of that. The waters in which we fish will become, over time, shallower. I was asked a question a year ago on another podcast, are you running out of runway? The answer is no, not yet. At the time I said I thought there was still another 5 years in it. Actually, I think there probably still are, but we will probably need to move gradually up the value curve in terms of more mid companies over time. This is something that actually doesn't bother us, and we're able to do because the nature of our fund has changed over the intervening period. We started with £100 million. AUM today is 365 million. Because we were able to absorb 2 other investment trusts last year, and performance has been good generally. But also our cousins at Dalton Investments, run by Jamie Rosenwald, who is also the CIO of RSM, have realized that their traditional metric, which was to invest in companies that were owner-operated or entrepreneur-operated, is becoming harder to do. That most of the action now is in activism and going after companies that are run by salarymen. So increasingly we combine with Dalton Investments and also with another company called now NAVF Select, which I think is a terrible name, but there we are. But it is a company that was started by the Dalton guys, also advised by RSM, for US investors who want to take advantage of this style of investing but can't hold the UK investment trust or don't want a sterling denominated share. So collectively, we now have a large amount of money that we can plow into particular companies that might otherwise be more recalcitrant. We're able to buy a sufficiently large percentage of just about any company we target now to get a voice.
I suppose is there almost a converse problem in that you mentioned the trust is getting bigger, you're running more money. Do you at some point reach a stage where you have kind of too much money to invest in a certain size of company and so on, without kind of running into liquidity problems? Like, do you have a kind of mentally have a sort of cap at which you wouldn't want the trust to grow any bigger? Or
it's another question I've been asked before. We're at 365 million. I've been saying for some while we need to get it over £500 million as soon as possible. Hasn't been possible to do via a secondary or offering of other shares because, as we know, the investment trust sector has had real problems as interest rates went up with the discount that a lot of them are trading at. Hasn't affected us that much, but has affected the sector. So there isn't a lot of fresh money to come in, but we're hoping that is starting to rectify as interest rates come down generally in the West and more slowly in the UK, but it will help. So we would look to increase the size of the fund when we can. Is $500 million all we need? No, we think we can operate perfectly happily at $1 billion and above. I mean, do we have a figure in mind? No, I'd like to get to $1 billion, and then we'll see how we're trading.
Yes, I suppose it's almost contrasting priorities, because on the one hand, trusts need to be bigger and bigger as wealth managers consolidate, but there are those kind of potential liquidity concerns that need to be borne in mind as well.
Yeah, I mean, you're right. The fund does need to be bigger because we need to get the attention of a consolidating investment industry. We want to be a core holding, not a holding that's on the periphery because one or two individual asset managers might be fans. And for that, we need to get bigger and bigger. It's always been the reason that Baillie Gifford has done so well is that their funds were so big. So we need to be bigger. That will actually help our liquidity because, we're sometimes more liquid than others. The bigger the fund gets, the easier it'll be to trade. And that will be good news for all investors, whether retail or institutional. There's no liquidity issue really with the investments. Some of the companies we go for have proved to be so illiquid we couldn't get a meaningful position. Wonderfully named Supertool was a company like that. When we realized we just weren't going to be able to get a meaningful percentage of the company's stock, we just sold it and we move on to the next one. But there are plenty of companies in our universe of 400 to 500 names that will be sufficiently liquid for us to play with. So we're not worried about that.
And talking of portfolio activity, what has been going on in the fund in recent times? I mean, did you, for example, manage to take advantage of the big sell-off we saw in the sort of opening of August? And otherwise, have there been any interesting kind of new additions to the fund, or beyond what you mentioned before, names that you've decided to kind of call time on?
Well, so the answer to the first part of the question is yes, we did. Unfortunately, the sell-off was very short-lived, as you know. It was effectively a day, the flash crash. But we were busy buying that day, as I'm sure most Japanese funds that have any liquidity were. I mean, luckily, we actually had more cash available then than we do at the moment, so that was good. We don't tend to talk about companies actually in the portfolio, only because unless the position is fully built, talking about them runs all sorts of risks of encouraging our arbitrageurs, getting other people to chase us, or even treading on an insider trading rule. So I'm not really going to talk about the portfolio other than to say we have several. I'm just looking at the percentages that we own of several companies. The top three holdings, for example, where 21.1%, 18.1%, and 18.4% of that company's outstanding. Now that is us as a concert party. So Nippon Active Value Fund, Nippon Active Value Fund Select, and Dalton Investments. So we're now routinely taking 20-25% of companies. We didn't used to do that.
And were there any other sort of broad, kind of, I guess, structural trends that the fund is now focusing on, or anything else for investors to be aware of in terms of kind of Japanese equities?
Well, I always say with us, you get two things. You get Japan, and people need some exposure to, probably the fastest growing market in the world. And you get Activism, which gives you the real cherry on top and has allowed us to outperform all the indices ever since we began. Hostage to fortune here, but I don't think that's going to change anytime in the near future. There have been no disasters since we began, i.e. there's never been a company that we lost a lot of money on. There's been companies that we may have lost small amounts on, either because we couldn't get the company to play, or we couldn't get a big enough shareholding, or the company turned out not to be what we expected. There was one company called Nitetsu Mining, which we bought because we liked the core business. It's a mining company, but actually it derives most of its profits and its worth from its Japan property or Tokyo property portfolio. We sold that company. We probably shouldn't have done it. It's done very, very well, actually. But it wasn't what we expected it to be. I think actually we probably didn't lose any money on Nitetsu money. So, the portfolio either does very little, it doesn't lose money, and then one or two of the things that we've been pushing for happen. And we think one has happened overnight, as I say. And we think that there are several situations where there's going to be something really interesting happening in the near future, which will allow us to move on to the next targets. I'm going in to Tokyo in November with Jamie. We're seeing about 9 or 10 of the companies that we have in the frame at the moment. We're also seeing all the private equity players. We're also seeing all the banks. We go there for a week. It's exhausting, but several of the companies that I'm expecting to do something may have already done it by the time we're due to go. So, we're right on the cusp of some interesting things happening.
And one other thing I just wanted to mention is there's been a lot of talk about there's been a Canadian company sort of making a bid for the Japanese operator of the kind of 7-Eleven convenience stores, which is seen as something interesting because of the implications it could have for, takeovers by foreign companies, which is something that's tended to be resisted, in Japan and so on.
Yeah.
What's your kind of take on that? I mean, is that a big seismic shift potentially? Would that have a big?
Well, unfortunately, it's potentially a seismic shift in the wrong direction. As I've been saying, the direction of travel in Japanese M&A is to facilitate company takeovers or companies going private or being absorbed into supply chains. There are two unfortunate things that have happened recently, which, in retrospect, the timing was unfortunate. First one is Nippon Steel trying to buy large US steel company. That, of course, has attracted all the banner waving and nationalism that you associate with US elections. So both candidates, Democratic and Republican, have come up with saying this is outrageous and we will stop it. And despite the fact that the American company is losing lots of money and wanted to be taken over by Nippon Steel, that is almost certainly going to be prevented. Had the Japanese had the good sense to wait until November or December to launch this, I think it would have gone through without too much fuss and bother, with a new president not paying much heed. So that looks like there's protectionism against the Japanese going on. Now, you mentioned Couche-Tard, who've bid for 7&I. So 7&I is actually the holding company for 7-Eleven, and they own the brand worldwide. It's a Japanese company. Do I think it will be that the takeover will be banned? No, but the company has already been moved into a category 3, which makes it harder for a takeover to happen. And certainly the financial regulators have to be satisfied. You might say, oh, this smacks of the worst type of protectionism, and isn't this a kind of an atavistic move in the wrong direction? Yes and no. 7-Eleven or 7&I in Japan is a kind of national institution. Japan does not have a Tesco's or a Sainsbury's or a Walgreens or any of these very large national supermarket chains that we in the West associate with how we buy our groceries. It is almost and this is the argument the company's put forward, and I think it's been accepted by the regulators to the extent that they want to see how this bid's going to work. But it is almost unthinkable that it would change the way it operates. It's on just about every street corner. It sells just about everything, and it is a Japanese institution. So yes, it isn't good that Couche-Tard are having such a hard time advancing their bid. I wouldn't bet that the company won't change hands, but it may not change hands with a Canadian buyer. But there is a lot of the Japanese are I've got into trouble for saying this before, but they are quite a nationalist, even racist country. They do not like foreign intervention. We would not have had the success we've had as a British company, or Dalton as an American business, without the domestic regulators pushing for change in Japan. But they are, and we have, and 7 and 9 might just be an outlier. We'll see.
Yep, want to keep an eye on. Well, lots of interesting food for thought there. I'm afraid that is all we have time for. So I'd just like to thank Paul for taking the time to chat. Thanks as always to our amazing producer, Maddie Apthorpe, and thanks to you for listening. Take care.
Thank you very much for having me.